Greetings, market rebels. Welcome to this week's sector situation video and macro measure. So we're going to incorporate both into one video. They're too intertwined, in my opinion, to not do at this point. Plus, it does help a little bit on time. So here's the macro measure intro slide. Here is the sector situation intro slide. And here is our trusty disclaimer from Market Rebellion. It's about a little bit after 3 p.m. here on the East Coast, Friday, June 14th. So I don't have the luxury of the closing prices, but we're not too far away. Here is the trusty intellectual property rights notice from Market Rebellion. And then here is the one slide and the one video to rule them all. In other words, we're not doing the other one. So don't worry about that because it will be intertwined into here. Kind of has to be, if you ask me, the way I look at the market. So I think it's the right thing to do. So we're doing it. I was going to go with creaky new highs as this week's theme, but this is essentially the same exact slide, I think. But oops, overclick there. Having a little bit of a mouse issue. But I'm going with this slide because which I think is virtually identical. But the whole reason for this is sort of at the last moment, I just decided that, look, I have to mention too many things in macro measure that are sector related for it to be, I think, thorough enough to try to make the case I plan to make. And given that, right, it'll take a lot of the so-called thunder from the sector situation if there were to be any, but it'll just take a lot of that. So it just becomes a little redundant and probably a waste of time, frankly, for everybody. So we're going to do it this way. I'm just going to go through the notes as I've been doing really quickly. My top note is that side note is you've got to ponder IV acquisition, in my mind at this juncture. We were talking about that on the cocktail hour at 1 p.m. Eastern, and I think everybody was on board. It was the discussion point I wanted to go with, just with the VIX where it was. I think it was a little bit lower at the time. Doesn't really matter. It's still extremely low if you ask me. You can see in the comments as to why, but I'll probably end up mentioning that anyway. Along with that, you could bring that up with Bill Johnson if you have access to his classes. If you have a coach like Scott or Stu, you could talk to them about these things. And you can also bring it up to some extent within the webinars that Scott and mainly Ryan and Greg do each and every week. So I would talk about like what is Wayne getting at with get yourself if you see things maybe similar to the way I do, you should maybe consider doing this. I want to do this. How do I do it? Right? They can maybe get you started. You can learn about maybe how to position things, how to get net long puts in the process, but still keep your theta under control. And then at the very least, if you're not sure you're ready to tackle that, I would learn the collar strategy. And that's something you can definitely cover with everyone I just mentioned to some extent. And naturally, Bill and coaches have a lot more time to go in depth and through everything when it comes to all this type of discussion because they're not conducting a live webinar in the market in real time, right? In most cases. Anyway, I would go with the playback speed to 2x as usual. And I would just note, right, that to this point, because this is a little bit of a departure point, we've been relying on the trend when in doubt. And I think that's worked out relatively well to very well, right, depending on who you are and how much you embraced it. There's no doubt that if you look at the trend of the Qs and the SPYs, it's continued to behoove you to have, right, that trend in mind and say, well, I'm going to keep going with it until it fails me. And it really hasn't failed you very much of late, right? And really since the lows that were put in, fortunately, when we did see some signs ahead of time, subsequent to the October lows from last year, we were ready for potential issues, I think, by and large. And that's good. And I think that's what we're coming to this week. I think the leadership just continues to narrow. And the way that I look at things, that's becoming concerning, not because it has to be in perfect lockstep all the time. We even talked about that last week, but just the fact that it's getting worse and it's just getting notably worse. So the diamonds and the IWM are just becoming, not only are they not really and having a fun time of it, but they're becoming more concerning if you ask me on the charts. I don't think there's an imminent crash Monday morning. I'm just saying that let's call it like we see it objectively right now. And that's where I see things right now. The Qs and SPYs are making highs, new all-time highs, right? Even today, I think the Qs did, and I want to say like maybe on Wednesday, the spiders did, and they haven't been back there, but they're not very far removed from it. And you can't even rule out more from them. But this is becoming, as many people know, more and more narrow. So do you fight against it right now? I would say probably not. Are there other things you can do to be smart? I think in the long term about a situation like this, yes. And I already mentioned those, some of those above, and talked about a little bit about that in the in the cocktail hour. But it's not just right the diamonds and IWM. It's a lot of sectors are flashing concern as well. So we've been on the lookout for double tops, lower highs, false breakouts, and real breakouts, and a lot of the things that are not so good. In other words, not a legit breakout. In other words, a lot of that stuff, like the double tops, et cetera, that is appearing. And it's just concerning. It's a snapshot in time. We don't know for sure if there's going to be follow through, or we're just seeing a wiggle in a concerning way. And next week, there's going to be a waggle that's going to erase all that. We've seen that happen in the recent weeks where we've said, look, kind of negative on the sectors, getting a little bit better, negative again, getting a little better. And then finally this week, definitely negative, right? Versus last week, which looked a lot better, I thought. So it's really been flip-flopping around. As I noted, the market breadth divergences are worsening. I think there's explanations for what's happening in the dollar, in yields, and also in the VIX as well, which we'll just briefly touch on. But I think there's massive complacency at this point. There are so many risks there, and you could say, well, they're always there, but I think they really are percolating, right? I think a lot of these risks are percolating. I think there's more risk than is typically the case. At least that's my perception. And I think those risks are starting to percolate a little bit more. And so I don't like that, right? To me, that is definitely concerning when you've had the kind of run that you've had, and the VIX is flashing a 12 handle here. You're really close to the lowest. You're not very far removed, really, is another way to put it, from the lowest lows we've seen in the VIX since 2019. So it's an opportune time, if you feel similarly to me, and really Pete and Ryan and Greg and Bill, everyone that was on there really was at that point in time on the cocktail hour discussion. We're all kind of in agreement, and there's a lot of experience there. Not that we're always right, but I think long-term positioning, if you can get cheap IV out in time, would be a smart move. You just need to know what you're doing and how to manage it. And that's, something that just needs to be learned, but it's something that I would be doing in a big way if I were still doing my floor trading days or my desk trading days, just because I think it's smart. Anyway, NVIDIA, split adjusted, right? We talked about this. I'm keeping this note here because I think, talked about it in one of the videos recently. And the reason why is because it's become really the dominant stock, right? Everyone's sort of taken a back seat to them at this point. And we talked about a few weeks ago how there's some projections actually had this thing going to 1337 pre-split. So that would work out to about 133.70. Last that I saw, it got to 132.84. So it was less than $1 split adjusted from that projection that seemed pretty aggressive, 2 to 3 weeks ago. We really started talking about it. And that to me is a projection. I said that I think I spent time discussing why I had some respect for that projection and why I thought it could matter. And just to elaborate on that, I think right when your lead stock gets to what could be a really important level, if it sort of gets hit with a wall of resistance there and starts to turn around, then you really have lost your big leader, right? It's basically the Achilles of your force, right? You've lost that. And that's a big deal potentially. So I think you've got to keep your eye on that. If it shreds right through it, right, that probably means there's even more upside, which a lot of people probably are having a difficult time understanding or accepting. And I can understand how they feel. But my point is that, right, the charts are the charts, and money flow is money flow. And when you're in this kind of a manic buying cycle, the way that you appear to be, the rationale and really prudent thought is largely out the window. And if you embrace it and go with it and just are smart and you roll the way we always advocate, then in a situation like that anyway, we advocate that, then you can stay into that and benefit from it despite the perceived risk that's there, which there could be quite a bit. I still think the market and Nvidia has upside potentially, but I also see the cracks sort of forming and worsening, and that's where we're at this week. I do think that the summer tends to be good this fourth year, but the buybacks are starting to dry up. From what we're learning, those are more powerful. These bold buybacks are more powerful than what I had really given them credit for. So, in other words, they could be largely responsible for a lot of the really nearly incessant buying in some big names that helps these indices, and that's set to really drop off significantly. And you could have a back half of the month sort of profit taking retracement episode as a result. So I think you have to keep that in mind. I also think, and I've been reiterating this again, this is why we don't fight the trend, but just get ready, because there's been this sort of swirling issue with all these bogus data policies that are promulgated by these various outlets, the government, government, quasi government, other fraud organizations, but the consumer, housing, inflation. Even Powell kind of called out the jobs bogusness, if that's the word, this week in terms of what's been put out by certain parties. And so that's not something you normally see, that the head of the Fed actually has an issue with data, right? That they feel is like, well, not that they think it's wrong, they think it's actually been manufactured. So that just gives you an idea, I think, more validation on this game that's being played by all these various parties is just that, and it could end really ugly. Their desire to rose-colored lens everything to the extent that they're doing it might lead to a problem, especially if a euro banking crisis ratchets up or geopolitical ratchets up. And that seems to be possible. It seems to be more possible this week to me than it was, let's say, a month ago. So when we were just kind of keeping our eyes out for it. So to me, the VIX is looking not only complacent, but arrogant, because this stuff is not only there and it could become a flashpoint at any time, but I think it's trending in that direction pretty strongly. In other words, momentum's picking up, that something is going to really happen. So that's why I'm really a little more like, okay, I don't normally show up here and try to get everyone worried or something, but I just got to call it like I see it, right? You're not really helping people out if you're just concocting things. So I'm telling you what I really think just from all the years I've been doing this. Anyway, that's what I do every week, but I just, I don't like having to show up and be the bearer of concerning news. I'm not saying there's an immediate crash. I just think you approach the market with prudence. That's where the Esterhaus warning comes in. You can figure out what that is or look into it. If you don't know what that means, just look up Esterhaus and you'll find it. But the all we've got left are XLK and XLC, really, aside from a few other mega caps, like in terms of sectors. So that's a problem. Other things aren't. Everything else isn't awful, right? But some of them are. Some things are just kind of hanging in there, but they're not really doing much. And it seems like there's a reluctance for a lot of other things to really participate in this party. The market's very dynamic. It could all change by Monday or Tuesday of next week, but we're looking at things now. And to me and my, from my perspective, they look concerning. So the sectors are becoming more concerning on balance as a result. And there's more canaries that are grasping for breath at this point. As I said, there's various reasons why the dollar, the yields, yield curve, and VIX are acting the way they are. And we can't forget, right, despite me sounding much more concerned, I think, than I have been for a while, the trend remains up until further notice, and breadth and other factors are just making it harder to love this market, which perversely is a good thing for the market. Bad for shorts, good for longs typically, but at some point it won't be. And I think we're getting closer to that point right now. The Esterhaus warning is there, and that essentially means be careful out there. And I am leaving many items off the table despite that wordy intro, just because there's a lot out there and we can't possibly cover it all. So let me just stop and we will get into the charts. We'll get a new share going, and I'll move my slides off to the side so they're not in the way. I'll just kind of keep them there for reference, and we'll pull in what we have to on my main screen, which should be screen number 4, share, and it looks like it's working. So right away, you can see that I've got the Qs up here, and they're really the all-time high Qs, we should say. And they're really, at this point, starting to get a little short-term stretched and sort of stretched on the daily, right? So have we seen higher readings in short term and also on daily? I think we have, right? I don't think this is the highest RSI reading I've ever had on the Qs. You can see that right now it's very close to where it was at a prior time, and it didn't really result in an immediate immediate undoing of the Qs. It did lead. It was just maybe like a week in front of a little bit of a pullback that time. But that's just how the math works out. But we are approaching really on the RSI about 79, 78 reading on the daily. And you don't see that in a major index that often. You do see it, but it doesn't happen that often. So let's just take a look at the last 5 years. And remember, there should be some extreme readings on here because of the post-COVID madness, right? And you can see that you're getting up towards some high levels that in the past it's been, okay, short-term overbought. So one would be the one we discussed. Another one is back here, right? And you can sort of see there's a little bit of a pullback after that. So I don't expect this to be like clockwork. Hey, Wayne pulled up an extremely or relatively high, we should say significantly high RSI reading, and the market immediately reversed and turned around. It's just that you can see that in all the years going back to 2019, there's a few that are close to this, maybe even exceeded a little bit, which back in these days especially, that was again kind of like the COVID and the COVID situation was I think unfolding. I want to say that was unfolding then. But that is rare, right? So you're getting rare, you're short-term rare. Some of the lines that I have been working with that we kept saying, like they have a funny way, the market has a funny way of getting to them, right? If I don't want to do this, but if I pulled these things out further in time, it would say, right, it would show that, okay, if you really reach this ultimate resistance level, there's a lot more upside. So I continue to despite kind of sounding concerning, hopefully not apocalyptic, but concerning, I still think there's a lot more upside potential. And we just don't know how things can work out. And we have to be dynamic, just like the market is, and be willing, which means you have to be flexible, right? And not lock yourself in. But I just think in the short run, there's some signs that have showed up that say, hey, this is overbought. The leadership is very narrow. They've taken this a little too far, too fast. Probably the buybacks really help this a lot more. Oops, overclick. I'm having this mouse issue where it double clicks when I don't want it to. I'm not sure what's causing that. I keep trying to work with my computer, but I keep getting nowhere. Anyway, this is just short-term overbought period, right? So doesn't mean it immediately has to go down. I'm just saying that the buybacks being as impactful as they turned out to be, you can't be surprised if we start to see some profit taking maybe right next week, right? And maybe in the second half of June, there'll be a little bit of pullback. And then that would be kind of like probably my most favorite scenario is that we start to see a little bit of give back here, which might not make for great trading, by the way. So just get ready with that. But then you could have that start of July, start of the month. They could be primed to start running into the EPS releases. And then if those are, let's say, convincing enough to hang their hats on, they could print massive new highs from there in July, maybe through July into August. And then, right, kind of do their late summer thing that they typically do, which is sort of like get the market very high. That allows it to kind of drift back in the second half of May through Labor Day. And then you end up with, a still decent performance. September, not that great typically. And that's usually not such a wonderful month. But that would be just off the top of my head, my most favored scenario, because it plays out according to the fourth year of the presidential cycle that's been tracking well. for the years now, right? So it's not like we're big analog players. Like, oh, the analog says this, we're going to do this. But when it keeps tracking, we stick with it, right? Because it seems to be working. It seems to be playing out. It seems to be showing that there's some validity to it. Spiders, though, obviously another right major index ETF that made a new all-time high. And the nice thing about the spiders right now relative to the Qs is they're not as overbought, but they are right still relatively overbought. I mean, if you go on here, you still look, despite today's kind of the last couple of days of pausing, you're still at a 72 reading. So I don't think that's as extreme as getting near 79 or 80. Clearly, right? You can say that there's going to be probably several readings that are above here over the years for sure. But it's still relatively high, and I think you just have to be on guard for that as well. So again, to me, that sets you up for more of a short term probability that you pull back. What would avert that would obviously be more of the same, right? Where they just keep going after mega caps like Nvidia as if it's going out of style. You can't get any more, you can't get any more of those shares at some point. You're locked out. You've got to buy now. Or right, Apple too, Microsoft too, Meta, Google, the rest of the gang, right? That kind of stuff. If they keep doing that, then they keep doing that. That could certainly do it. Or right, they could sort of let those things sort of go into chill mode and start buying everything else up, or most of everything else up. And that would also obviously keep the major indices buoyed, by extension, obviously their ETFs buoyed. So that could be the case as well. I wouldn't worry extremely too much, right, about this Bollinger Band excursion we've got here. You could see, right, the reason why these bands are maybe worth something at times. I think they are, which is why I keep them, is because you don't usually operate for long outside of the bands. So normally, once you get outside of the bands, right, there's a little bit of sort of reversion back into the bands, and you're a little extended, but the bands are so narrow here that an excursion here beyond the band isn't really the same thing as when the band when you have really wide bands because the trend's been in place, and then you kind of get that final sort of melty, blow offy type action. We really haven't gotten that, right? It's been a little bit of a melt up in certain places. Probably you would say, right? What comes to mind, and that we all know the reason why it's got to be like the closest thing to a melt up is probably SMH, right? But it's really been, it depends on how you chart it, right? Depends on how you want to set up your scaling and all that. So I can certainly make it look more extreme by doing that, right? Then, and it does. I mean, we can't really deny that the thing's checking in now with a 77 reading of its own, today on the RSI. Plenty of gaps galore, but again, this is outside of its Bollinger Bands. That is something I would take a little more seriously because those bands are fairly wide at this point. If you look at the red and green band, you can see just how wide those bands are, and they've started widening from where they were a couple of weeks ago, and now right there, you're out there. And so that is a little absurd, probably, right? But does it mean immediate crash? No, it just means that probably there's going to be, I would say in the near future, there's probably going to be a decent chance that this thing reverts, especially if NVIDIA hits that target. We talked about the 1337 pre-split that I thought was an aggressive target and thought it could get there. But like I said, it came within. Today's high is, I think, 132.84. So, post split, you're talking about less than $1 of difference, right? It's kind of like 132.80 pre-split versus 13,370. So post, it's about $90 shy, but it's only on the pre-split, $90 shy. I'm sorry, 90 cents shy roughly on post split. So depends on how you want to look at it. It doesn't, 90 seems like a much bigger miss, but again, percentage wise, it's about the same thing. So it hasn't quite made it there. Maybe it will next week, but if it stops at that sort of, at this point, it would be really 134 or lower, just to kind of round it off. If it stops at 134 or lower and then starts to really have trouble, that could be sort of a warning sign for, okay, this leadership is stalled, and maybe that hurts the SMH a little bit. Excuse me, and maybe it hurts the market, because XLK and XLC have been so important to the recent the recent surge to all-time highs. There's XLK, just getting a little water, and there's XLC right there. So those are really the two biggies that are left that are not really flashing concerning of a problem as others. This is clearly off of its high, but it is bouncing right off of the 20-day for now. So it's not too far removed from the all-time high. Other things are, though. Other things are. But going back, just to kind of put a wrap on the Qs and SPYs, because we've covered those. Let's go back. I think you just have to be prepared for little short-term overboughtness, a little extended. So I would say in the Qs, right, don't fight it until it gives you a reason to. That's basically my approach. I don't like the other approach for me. It could work really well for others. I never got it to work really well for myself, where as soon as it hits your projection and doesn't go through, I know people that will say, well, once it gets to your projection, it doesn't go through, I start shorting it. And that's not, for me, like that, it just isn't good enough. I can, if it works for them, who am I to say they shouldn't do it? But for me, I need to see some weakness start to creep in. And I don't think you can say that you have yet. You need to really at least take out this support line, which means today's low, right? You got to, if you're looking at the Qs, you've got to break down below something for me to start saying, okay, this thing might start reverting. Just if you had a 479 number and it got there and that was it and started selling off mildly, I wouldn't be short on that. As this trend is too strong. If you did that all the way up, you probably are in trouble, right? But waiting for something to finally evidence itself has been really the thing that got things to click much better for me a long time ago, versus sort of just shorting at predetermined targets. If the stock stopped there, that was it. Temporarily stop there. Some people do that. Like I said, it might work great for them, and I hope it does. But for me, that did never consistently worked well enough for me to continue to do it. Spiders, right? I would just do the same thing. I mean, I would just put a line right underneath here, and I would put a line right underneath there, and you need some kind of a crack to really. You need some kind of a crack of support, in my book, to really start thinking about, I'm going to fade this. And again, that probably comes on today's low, and that's at about 539.85. So you need to start seeing a little bit of weakness creep in here. But remember, the one reason why it's so hard is because there's usually good support to win, fighting against trends, is because the trend resumes for a lot longer than most people assume it can. That's one reason. But another reason is there's a lot of support, right? All these places that kind of flatlines where it kind of hesitated for a while, and then rising SMAs and things like that, there's buyers that decide to come in near those levels. That's why I think our flat lines work, and we use those extensively for triggers and targets, because people look at the prior price action, they see where the stock has respected a level, and if they look to buy, then they try to get in near those levels, or sell, of course, near those levels. But that would be my first sign. You've got to probably wait for today's low to be taken out, because remember, you're basically right $2 off of the all-time high in here. And you might say, how is this even possible with all these things going wrong? But look, I can try to help with that in terms of, you're probably right about all of your qualms that you have with this market are probably right. But if money's still flowing in, and there's still more buyers than sellers buying more shares than sellers are selling shares, on balance, with all the weights the way they work out in the indices, in the ETFs, the market will just keep going. You really need to have that moment where things shift, where there's really net selling that is occurring in across the board with on the factors, right, that we just discussed. You need to have that. And if you don't get that, it's really hard to break a trend, that especially one that's supported by the power structure. The entire power structure really doesn't want to see at this juncture, it seems, not that they won't change, but they haven't wanted things to go down. They've been doing what they can to keep things going up. And frankly, it's made a mockery of the rate increases. But that's not like that's not unprecedented, right? It's nothing new. It happens a lot, and it just eventually, right? I think this is it spells problematic situation for the American consumer, European consumer, Asian consumers, South American consumers, etc. But until it really the market wants to allow that to be reflected, um, it won't be, right, because the natural course of things is just to buy, right? That's what they typically do. When in doubt, buy, and without a good reason to sell, they don't want to sell. Anyway, here's your support line, roughly speaking. So again, you would need to have today's low and the diamonds get taken out to really break down. You need that to happen. That there's the support line. You might have an issue with it. If you want to have an issue with it, that's fine. You could probably wait for 381-ish instead as an alternate to this aggressive selling level. That would put you near this fib retracement of 23.6, and it would put you near this 150-day SMA. But it looks like I need to adjust this a little bit because we might have to revise that. So let me type in edit of 401 on the nose, edit properties. The highest point would be 401 on the nose. So this could change that slightly. Let's see. So the 380, yeah. So it's 38. It would probably put you, there's a level there. Really, I'd probably still stick with this 150, which because it's so close to this low. But the important thing here, I think, is that things are rolling over right now on along with this indicator view we've got here, and they're saving it at the moment, right? They are saving it. It's holding above as of right now, but you can see there's a potential low or high in here, potential low or high that's kind of hidden or lost in there, where it doesn't really stick out. It's kind of like a couple of highs there. So you've got to be really wary of, hey, of what if this does start to break down below there, because that selling, I think, extends down to your 200, right? And there's support right at the 38.2. There is the 38.2, and then there's the purple 200 coming in there. So there's three reasons to think that if we do get more selling in the Dow, and it does take out the key levels here. First one would be the 150, along with that low right there, and then these other levels right in here, which are pretty important. Let's just ballpark it at 377. Then you would open up another 2% downside from there, for starters. So that doesn't look great right now. I've seen worse, but it doesn't look great. And the IWM also looks very challenged. I think it made a new low here today. It got right towards that 150 there, kind of that rust colored brown right there. So it got down there. It's been unimpressive. We know that, right? There's a lot of potential in there. We talked about it when it was trying to act better. I think it should trade up to about 264 if the other indices kind of hovered around here. If they reprice this thing, 268, excuse me, if they reprice this thing the way that they have other major index ETFs with an inflation factor put into it. But that doesn't mean anything, right? You need to see things acting better. You could end up with sort of an inverted head and shoulders if they start to come after this thing here in the short run. So there's other patterns in here, but if you just sort of see that inverted head and shoulders right there. So if we start to see bullish action, I wouldn't laugh it off, right? Because they could try to make some hay out of that. That's what they do. There was a really absurd trap put into this thing this week off of one massage, to say the least, data point. So they literally closed this thing at, they had a low of 198.42 on, I think that was on Monday or Tuesday. Was that Tuesday? Let's see. Yeah. there you go, 610. This is 611. So yeah, that's Tuesday. And so, the next day you're trading up to 207 and change. Just utterly ridiculous. But that's the modern market right there. But this thing's sort of breaking down, right? You just don't, it's not looking good. It had its chance, right? Rates have really dropped, which would normally, as far as the TNX is concerned, over the last, say, month. And this thing, if you go back about a month, right, it's acted poorly in the face of rates coming off by and large. Excuse me. So, not a good look. It's not over yet, but if you take out the 150, naturally you've got your flat lines. But I think you're looking at this level down here. I've had a bearish idea in here. I think the trigger was somewhere around 202 and change, or 203. I can't remember. I don't even know if anyone was able to get in, actually, now that I look at it, because, well, maybe they were, anyone that really didn't like it. But this sort of had this like ganglion of all these SMAs, and just acting poorly. And yeah, well, they started to really work it lower on the opening, took it down, but they have it off the lows as of right now. But just not a good look. And I do think too that I shouldn't fail to mention that the way that I do things has a little bit of an anticipatory factor to it. And I'm anticipating that if we do have a rough back half of June, that's really going to turn some of these charts more decisively bearish if you end the month poorly. So just keep that in mind, because things could go from looking a little concerning, maybe in your eyes a lot concerning, maybe in my eyes a lot concerning right now, to far more concerning, or very concerning, to say the least. So I think that's what you got to keep in mind. Let's jump over to the breadth view, which should be right about here. And I'll go, it doesn't really matter what I keep up here, but I guess at this point, the Qs are really the leader. So we'll just flash that up there. And I did kind of reduce the size of the price subgraph here. And I tried to emphasize the size of some of these measures. And I'm really not going to get into these measures, all of them, right? Like in terms of detailed discussion of them. But I just would say that if you would want you to say, right, so just things are not looking good, right? Like new highs, new lows. You can see the new highs are really drying up here. There's not so many being made. There were a lot more being made here, right? It's kind of like you kind of feel like, oh, am I getting kind of in towards a lull or a later part of the cycle? You're getting new lows being made, right? They're starting to pick up. Normalized new lows are starting to pick up. You can see the McClellan oscillator and the McClellan summation. They're both really not performing right now. They're both really struggling. So that's not good if you're someone that thinks breadth is important. And I do. I just don't think it's instantaneous. So I don't panic when it's not so great. But when it starts to worsen and other things worsen along with it, and this is all worsening, that's when I start to get more concerned about it. Kind of saying like, okay, there's a divergence, there's a divergence, there's a divergence. But now this divergence is really stark. And you don't really want to see that. Now, my experience again is that if you just bet on that and say, well, this thing's got to start catching down with the ugly breadth, you're making a mistake. That's been my experience. You still have to wait for the market to crack, unless you want to position the way we talked about at the top of the video. If you do that, it's a different story. But this market breadth situation is not looking good. The leadership is narrowing. Let's take a look at sectors to kind of show that. I'll pull some of these sectors over here for us. This is where we're combining our videos this week. But look, here's your XLE, right? Look at this. I'll try to make this, oops, come on. I want to try to get a better view for everyone, but you can see, I know there's a lot on your screen probably, but you can see that this just hasn't been, this isn't good. I'll make this a little larger. XLF is not a good situation right now. And XTN, excuse me, is also a pretty bad situation right now. So those three are sort of canaries or watches for me, where they're not always in harmony or harmonic or something, but you really prefer to see at least a few of them working. And not only are none of them working, but they're all looking worse and worse. And so those, think about the capital flowing through the economy. Think of that in terms of your financials. Think about energy demand. Think about goods flowing through your economy. So this just doesn't look good. I can't spin that any other way. And other things that have been sort of hanging in there, even if it's been unimpressively, the industrials and materials have been hit pretty hard this week in the second half of the week, and they're making new lows. This is not good, right? So this is not good. Discretionary. It tried to go and put a little breakout together, right? Despite Costco just being a stellar stock, this thing's backed right back off. Staples, right? They're not doing anything special. They're hanging in there, but that kind of makes sense given the uncertainty of where we might be right now. You might have this sort of defensive. They had maybe a little defensive positioning, and XLV is hanging in there, but it has a double top, and that's the thing about these defensive positioning moves that people make. It might not get slammed the way other things will, but usually when they do risk off, they come and it's serious. They sell almost everything. They get around to selling almost everything. XLRE, right? Flashing maybe a double top. So that leaves you, right? If you think about what we've covered, that leaves you only with XLK as the big leader. And that's just because, right, it's basically similar to the Qs, and it's got the SMH components in there to an extent. So that's why you've got this, which is starting to get quite high, right? You can see the RSI on that is quite high in XLK. So, oh no, you can't see that on this view. My bad. I'll just flash that. I'll just discuss that really quickly. Let me find, why am I not seeing that on my, it should be here. Okay, I'll get you the XL. Yeah, XLK is at 77 on the daily right now. So again, you're not fighting against it, but it's really gotten up there. And it still has this kind of above the breakout level here in XLC, the other kind of leadership sector, but that's had a rough second half of the week as well. It is recovering today, but it did maybe break out. It pulled back to former resistance. It has held. That's a little bit of a good sign, but it does, right? It's sort of looking like little one day blip back up, or is it really going to support here? And I'm the way that a lot of other things are taking shape, the way breadth is taking shape. I'm thinking more along the lines of, well, this might support for a little bit, but if this all starts giving way, they're going to sell this too, and it would be kind of in bad technical shape pretty quickly because of the way that I chart. Not that my charting is the only way, but some simple old techniques let's bring it up on a better chart than that. But just simple old techniques that a lot of people never embraced, still laugh at, never stop laughing, continue to laugh at. But I don't know what it is about it, why these things work, but they do. I've never been able to figure out why this stuff works, but it might be legacy stuff. I don't know. But if you just do visuals on support lines, and you see when you go back and look at price action, when you start breaking down below these things, right, it can really get dicey, and you're below that. I could redraw that maybe even from this pullback low that's there and try to give you a line that really fits better. But you're either, depending on what you want to look at, you're either there or you're below. And so you're at risk, regardless of what your take is, you're at risk of losing that with one relatively bad session. And that would also lose your 20 SMA. That would open up the door to a visit to the 50 SMA here in gold. So very quickly, this sector could be under pressure, and who knows what happens from there. So you can't really deny that you've had this amazing run where you go from, let's say, 63 here in Oct, and you trade all the way up into the mid 80s. So you have, like, in just let's call it in what would that be, about 8 months, you end up with a 33% return on the sector ETF. So that's really quite a move, right, for the sector. You'll take that every 8 months. I know I would if I were long that, but that just gives you an idea. It's been a pretty respectable move here. Is it time for another retracement? Right? Is it time to start giving a little back? And I think this is vulnerable to it, just like all these other sectors that we talked about. Let me try to bring up the one with I guess I clicked on one of two. Let's see if this one, nope, that is the wrong one. Let's go back to there. Let's get this one over here and I'll pull it over. But this one has the RSI. So you could see that a lot of these things are already in trouble, right? Look how you're just getting sold off with 33 RSI and you're in energy. You're already at 40. So these things are, some of them are getting down there, but they're not devastated to the point where they can't fall anymore. The one thing I would like to mention about specifically about XLE is that it is breaking down below. If it lets me get this, for some reason, especially when I do the Zoom, it's it doesn't like my computer and Zoom are just at odds with each other almost constantly. It seems like I don't know why. I think I might be having like a motherboard issue that I can't fix, which is why everything I've tried has not produced adequate results. And I've been doing the fixes of different kinds and looking into this stuff for way too long, just because I'm frustrated and want it fixed. I'm just too busy to build a new computer right now. But there's your 200 and your 150 that you ducked below here today in XLE. And remember, right, when you have these widely followed, especially the 200, you really have a situation where, okay, a lot of people are going to take note of that, and a lot of people could, panic. It's a great spot to really pull reversals off from if you're the gang, right? Because it sort of brings about this sort of legacy approach, panic from everyone using round number SMAs like the 200. I don't even know where that came from, but it became very popular. And that's what can often happen at something that's very widely followed, very, very popularly used and employed by people. So just be careful, because they do have a tendency to sort of flash weakness and then rip things back up. I mean, that's pretty much what they've been doing now for the last 2.5 months, right? Plunge, rip it back up, 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 and then plunge and maybe rip it back up. So just be careful. That's why your discipline has to be there when you trade breakdowns, even in things that have intermediate term downtrends in place, because these guys are just really good at, right, when you finally see enough weakness, if you wait too long, they're going to get you most times, right? Most times, not always, but most times. So the point though is, if this is not a false breakdown, this is starting to get really ugly. The retrace is now getting into where you start losing confidence that it's going to come back, right? You're not that it's not the end of the world. The worst would be below 61.8 naturally, but if that fails, you still have a little bit of hope left. But really, at that point, most of your uptrend has been completely undone. I mean, that's the whole point of looking at this. So that means that they couldn't hold on to the gains. Buyers didn't step in. And it just, to me, I don't know the specifics of the oil market. I always make that clear. I used to way back when I traded a few different oil stocks, but I don't have time for that in my role as, really a UOA pro and helping Ryan and Greg here and there when I can with the services that they tend to focus on more. I'm really swamped with UOA Pro and just trying to stay on top of the market news, different things like that. So I don't have time to really delve into any specific sector the way I would like to. And so having said that, right, I don't know the specifics here, but just in general, not a good look for a very important sector that the demand just doesn't seem to be there. It appears due to really strong economic activity, which I don't think we're experiencing here, nor do I see that in many places right around the globe. I think India, other places like that are more or less the exceptions, and the globe itself is not really firing the way it had in years past. Could change, we'll see, but I'm concerned about that, just to say the least. Let's take a look at a couple more things and then we'll wrap up, because we do typically, I won't look at the ETFs, but for those that have a problem with housing like me, I don't know exactly how this is held up when I just think about it as a regular person, but the charts continue to hold up in there. You can sort of see a little bit of maybe a triangle forming. So you might want to be careful on that. But now that maybe rates are going to have to struggle to rise, this could just be a consolidation, not necessarily a precursor or prelude to a breakdown. But they're hanging in there. The IYR is also hanging in there. You've got a triangle. I think I don't even have to draw in the U.S. real estate ETF, right? So these things are still hanging in there. They're not breaking apart. At one point this week, though, they were working some magic in KRE, the regional banking ETF, on earlier in the week. But you could see where we're closing, and you could see how your proximity to the lowest lows of the year so far. And so that is something that maybe bears watching, because if you start taking out those lows in the regional banks, that could bring about, of course, selling begets selling, and just like buying begets buying. So you could be on your way towards concerning levels, right? Levels you haven't seen that since last year. That could be the start of that, with just a little bit more weakness here. So that also, I think, bears watching. And given right what's happening in Europe, there's some news out about the French/European banking system. You may want to look into that. That's also a concern. So there's a lot of things happening. There's the Cuba thing happening. We could go on and on. You would think, well, if with all this stuff going on, why are we not seeing better performance out of gold and silver? Well, I think, right, I think the problem is the dollar. The dollar, there's usually a pretty decent inverse correlation. And if you look at what happened in DXY this week, you'll see, I think, that the DXY has started lifting back up again. Oh, I'm sorry, this is the weekly. My bad. I want to check these out on the daily. But it doesn't matter on some of the other ones you looked at, because it is consolidation, but they've moved the dollar back up here towards the end of the week. I don't know if that's a little bit of safety situation. Yields have dropped off. Again, like, I think this is partially due to the data, but I forgot TNX, and then we've got to do this, and then CGI, and then home TNX CGI. Let's see if that picks it up. But these yields are down, but I think that's because people are buying bonds. I think they're just driving up the price of bonds and bringing the yields down, because it's more of a safety situation now. So I don't think this is having that wonderful lifting effect it had for so long for that reason. This is why it's hard sometimes in the market, because you think, oh yeah, well, yields are dropping, stocks should go up, but it's not always like that. And that, these different flows of funds for different reasons is, I think, largely responsible for some of these pretty reliable relationships breaking down at times. So there you go on that. I'm trying to think if there's anything else we should definitely flash. Probably the last thing I should really definitely flash in this combo video is just the VIX, just to make the case of, I hate to see people maybe not knowing what to do, how to do it. And there may be an opportunity here. And I hate to see people not be prepared. I hate to see people give back a lot of their gains. I hate to see people miss opportunities. That's what we're trying to help avoid. But the VIX isn't on the lowest low we've seen of the year. But remember, when we saw this right back in May, we talked about it. If I do it this way, I've got to go all the way back to 2019 to really get levels that were very much lower than this. So you got to keep that in mind, that they're kind of inviting you to buy the VIX, right? You can see that clearly on this chart. You've got to go back to here at the lows of 2024, which were only 3 weeks ago. You've got to go back to the fall of 2019, I think, which I believe is the pre-COVID madness. That's before all, the world turned on its ear and everything got increasingly stupid and insane since, essentially. So that's where you are in terms of opportunity in the VIX. And that's why I'm kind of finishing with this little table pound of, maybe it's worth looking at, right? Maybe it's something you could, at least, if you don't know what to do, talk to the guys I mentioned, talk to Ryan, talk to Greg, talk to Bill, talk to Scott, talk to Stu, talk to your rep if you really want to learn it in depth. I know Ryan did a recorded course that's, I'm sure, very good. I didn't watch it the whole thing, but I mean, he and I have been partners for 25 years, so I know what he likely covered since we use the same information ourselves for our own stuff over the course of the years. But anyway, that's what I would kind of end on. Not that that means immediate crash. It just means that you, I think, got to be on guard, and you have. This is a time, I think, just to be very careful relative to the way that it's been. I could be dead wrong as always. You never know the future, but maybe things just keep roaring. But I think if they do in the fashion they're doing it in, that to me means that the rallies in the short run is on borrowed time. It just probably will be. Unless, right, you see something you don't see very often, which would sort of be like a 98, 99 type of spike. Could happen. Obviously, we know what would be the leader of that, but I'm not anticipating that. I don't think that's going to happen. I do think that people fighting against NVIDIA, uh, they could be in for a real slugfest. Is maybe some people think it's crazy already, and maybe it is, and I don't know one way or the other whether or not it is. I'm just saying that people don't really appreciate how far a mania can carry and really how far a price can run. And that's why I'm very reluctant to fight against trends all that often, especially in things that are flashpoints. And I don't think there's a bigger one in the world in terms of stock trading right now than that stock than Nvidia. So I'm going to end it on that note. Just learn what you need to learn and be prepared and be disciplined, and prudent. And at times like this, that usually pays off to be that way. And then you're ahead of the game by versus almost everyone, frankly, unfortunately, because of the state of things, the nature of things, the way that the investment business tends to work. So on that note, I'm going to say thank you all for hanging out for this nearly an hour, I think, here. But we did combine two videos into one, so there's that. If you play it on 2X, you're not doing too bad, because you're getting this done in less than a half an hour, right about that much. And so I hope you had a great trading week this week. I hope that everyone has a great and safe weekend as always here in the summer about to get started officially. And I will wish everyone a great week. Next week, we're beyond the Fed, but we're also mostly beyond buybacks. And so that's why we're going to be careful, potentially next week, as we'll see if this market can hold up on its own at these elevated levels without these strong buybacks in place. So everyone have a great weekend, great week ahead, as I noted for the second time. And thank you again for tuning in. I do hope you got something out of this video that will help you out this week or some week in the future. Thanks again.